Welcome back. You're listening to Risk Required, the series and book all about the inside track to finance, the tips and tricks that could allow you to find financial freedom and retire from the 9 to 5. I'm Ed Pitford, and I'm back this week answering more of your questions. The information and opinions in this podcast are provided for informational and educational purposes only and do not constitute financial advice. The presenter, production and publisher are not responsible or liable for any analysis made by the audience based on the information in this recording. No parties warrant or guarantee the accuracy or completeness of any information. Audiences should always do their own research or consult an independent financial advisor who will advise based on the individual's specific circumstances. Before we get started, if you have any questions that you'd like answered, send them in to us on Instagram at RiskRequired or wherever you listen to your podcasts. So the first question we have today is, I have premium bonds, what shall I do with them? And for those who don't know what premium bonds are, this is a government scheme where you buy these bonds and then every month there's a draw and the prizes range from nothing to £25 at the bottom end and up to £1 million at the top end. So it sounds great. But if you look at the average return over a year on people owning premium bonds, you're looking at about 4.4%. And it is tax-free because they're prizes. It's not interest. But just kind of be aware that at the moment there's savings accounts offering more than that return. You can get roughly 5% on a savings account at the moment if you shop around. So they sound great, but actually you're probably better off having your money invested elsewhere. So with premium bonds, yes, you're not going to lose all your money because it's a government-backed scheme, but it's risk that's outside of your control if you look at it that way. It's effectively a lottery. It's not using your knowledge and insights to work out whether it's a risk worth taking. It just will be what it will be. And one thing worth remembering with premium bonds is that you could get zero return. So you could just be unlucky every draw and the return could be zero. So whilst the average is 4.4%, that will be skewed by the people getting the £1 million prize, and your return, it could be a lot less than 4.4%. So for a better chance of a better return, I would be investing that outside of premium bonds. So the next question is, should I get a credit card? The answer is probably yes. I don't know this person's individual circumstances. When you get a credit card, you have to be careful on your spending because you've effectively got access to more credit. You've got more opportunity then to go and spend that even though you don't have the money. So get a credit card, make sure that you're quite strict with yourself. But there's benefits. So you get a credit rating, which is important when you're coming to borrow larger amounts of money. But also, if you get a credit card with the interest-free purchases for 30 days, it means that you can effectively delay your monthly spend by 1 month and create more money capacity in the system, as it were, for you to go and invest. So if your normal monthly spend is kind of £1,500 a month, but half of that, say, goes on your accommodation, and that won't go on a credit card. But you might be able to put £500 of that onto a credit card each month. And what that does is delay that £500 so you don't have to pay it until the end of the next month. And therefore you have suddenly created £500 for you to play with in terms of, the very safe end, putting that into a savings account or starting to look at investing in stocks. And it's £500 that, as long as your salary keeps coming in, your spend keeps going out, you should always have. So effectively it doesn't boost your net worth by £500, but it boosts your cash available by £500 almost permanently. And when you're looking for a credit card, there's lots of websites out there which compare all the credit cards for you. There are websites though where you don't have to do the credit check to see if you're eligible. So I think it's good to find one of those before you get started, just to see what's out in the market before you have to give any of your details away. Someone else, I guess it's a pretty obvious answer, but should I get a 0% balance transfer or money transfer credit card to pay for my ski trip? And I guess there will be some circumstances where maybe that's the right thing to do. So if you're going to be selling shares in order to pay for the ski trip and go and do that, then you might want a 0% balance transfer as long as there's no fees on that and you've got the kind of capacity to pay it off at some point. But if you have no money, then taking out that credit to go on a ski trip isn't a great idea. It's harsh, but better to not go on the ski trip because all you're doing is delaying that pain. And in however long that is, 12 months, 18 months, you're going to have to find that money. And if you haven't been able to find it, you're going to start paying a very high interest rate. So no, that's not really what these balance transfers and money transfers are for. They're more used when people are consolidating expensive debt, or they're using them to invest in something where they're confident that even if that goes wrong, they've got another way to pay that off. You're listening to Risk Required. The next section is what have I been investing in this week. This isn't an advertisement for you to go out and invest in the same stuff. I want to make that very clear. So this week, my investment has been a follow-on investment, which means I've invested in this company before and I'm putting some more money into it. And the company is called Gosnells. They make a mead, which they've branded as Nectar. And you'll see this in some pubs around London, and you can go online and buy it if you want. The company has been going for quite a long time now, probably around 10 years or so. That was from nothing, effectively. It's a friend from uni that started this business. They were a consultant doing management consultancy, really long days, and they had a kind of passion for brewing mead. So they quit their job and decided to go and start this business. It's been a tough journey for them, kind of witnessing the ups and downs as we go through this, times where they'll be scraping by on their cash flow. But it's starting to get to a pretty good place and starting to look at those bigger contracts, potentially breaking into supermarkets soon. And it's in plenty of pubs now. It's quite exciting when you go into a pub and you see it there. They've also had to do a bit of a pivot. So kind of originally it was basically Weir Mead. People didn't really know what that is, and then they were they're probably going against quite a large portion of the industry, and now they're kind of branding as Nectar, and it's very clear that they're going after the cider market. And the product is they're a B Corp and they're bee friendly. They're a healthier alternative to cider. So the amount of sugar in the drink is a lot lower than a cider. So it's quite interesting to see the premium competitor coming into the cider industry. So that gives quite a lot of optimism for the future. It's a company I've invested in before, so I want it to continue to do well. And I feel like they're a lot closer to an exit than some of the companies I would normally invest in. So I'm hoping with this one that I might get my money back within 5 years and at a reasonable return. You'll remember in one of the earlier episodes I said that as kind of young people, you're the ones out there seeing what's trending and what products are actually wanted by the user. So this is an interesting example of that, I guess, is if you're in the pubs, what are people trying? What are people liking? What are people chatting about? What are people recommending? Because me as an investor, I don't necessarily know that. So it's just to make sure you value all that knowledge you're picking up all the time. And then once you see those products, hear about those products, you can then look at going into finding out when their next investment round is, or whether they're open to investment right now. It doesn't have to be done in rounds. People can take investment at any point. So if you see something that looks interesting, it might be worth getting in touch with the company and seeing whether they're open for investment. And now we'll go back to some questions. The next question is an interesting one. It's when should I start saving for my child? It's always good to be maximizing your wealth, regardless of when. And so I think it doesn't matter what you're saving for or when that is. You want to be trying to do the most to maximize your wealth all the time. So effectively start now. Also, the ways you maximize your wealth are kind of independent of what you're saving for. You shouldn't be doing something different just because of what the money is going to be used for. You should be trying to just do the most optimal thing for your current situation of finances at the time. So next question, someone has some savings in their Monzo. So they've got these kind of pockets of savings set aside for different things. And they said, is it worth paying for Monzo Plus in order to access the slightly better savings rate? And having looked at the rates and looked at what's available on the market, you're better off taking it all out of Monzo and putting it into some of the other savings accounts that are available on the market. So you're looking at kind of up to 5% is out there at the moment with, free take it in and out whenever you like. And Monzo is offering 4 point something and 4 point something a bit more with their Plus account. So not worth paying for their Plus account if that's the only reason you're paying for it. And generally you're probably better off. I know they've made it super convenient, but if you really want to maximize that interest, opening an account somewhere else where you're getting a slightly higher rate. You're listening to Risk Required. And the next section is on personal stories. So this one came in, they're earning £30,000 a year. They have no debt other than a credit card that they pay off every month, but they have no investments either. And they have some savings, a few £100s of savings in Monzo pot. What should I do? This is quite an interesting one, because normally people have a lot of debt that needs consolidating or have a lot of money to invest. And this one's kind of very much on that flat plane of kind of getting in enough that I'm to cover my spending, and I've got a tiny bit for a rainy day. So that money in those savings pots is getting 4.2% or something like that. The lowest risk of all the options is just to take that out and put that into a savings account that gets you 5%, which they are available at the moment. That's 5% without being under any restrictions on when you can withdraw it or not. So that would be the lowest risk option to do. This is difficult because it's literally their only rainy day fund. So that is probably, if I was having to give advice, that's probably as far as I would go. But if they were minded to take a little more risk, then they could put that into a stocks and shares ISA. The returns you might be getting a kind of 7 or 8% tax-free on average, and there will be a lot of fluctuation in that, but that's a lot better than slightly better than the 5%. But as I say, we're kind of dealing with such small amounts, and that is your rainy day fund. I'd probably just go for savings account, one of the higher interest savings accounts, so you can access it whenever you need it. So we've got someone who has very little debt because it's just what they've got on that credit card each month, and very little in terms of investments because it's just a few £100s in savings. But this is actually a really good place to be. So they've got a salary coming in, the 30 grand a year, and they don't have huge debts, and they're in the UK. So they've got incredible access to finance. What I would be doing as this person is looking for a money transfer credit card. So they don't need a balance transfer credit card because they don't have credit card balances necessarily to pay off. They could, for that, assume if they're putting their monthly expenditure on a credit card, they've probably got 500 quid on there. They could balance transfer that, but the capacity to borrow should be higher than that. So you probably want to go for a money transfer credit card. So with a money transfer credit card, you're borrowing off that credit card and you're taking it out in cash effectively, but it will be a bank transfer to your current account. Again, make sure you look out for all the regulations. So sometimes it's only a 0% if you do it within the first 6 months of opening the account. Keep that account just for this purpose. Make sure that you're paying off the minimum by direct debit each month that you need to pay, and make sure you keep enough back when you're investing to pay that minimum. With that all out of the way, then it's, so this person, 30k a year, I imagine they'll probably be able to get a money transfer credit card for £2,000 or £3,000, preferably at a 0% fee with 0% interest, but maybe a 3% fee for 16 months or something in that region. And then it's what do they do with that? This isn't someone who has lots of investments, so if this goes wrong, it doesn't matter, they can just pay it off. We're probably going to be looking at something lower risk here. That might come in the form of a cash ISA or a term deposit, if it's effectively a savings account, but you have to keep it in there for 6 months or a year, and make sure that time you have to keep it in there is less than the term of the money transfer. And it's not like if you hit the end of that 16 months, whatever it is, and you can't afford to pay it back, you're suddenly in a whole load of trouble, but you'll probably be on a very high interest rate. No one's going to come after you, but you need to make sure that you have a plan for that, and it will get quite painful if you don't. It probably feels like quite a big job and something you don't really want to go and do, but you could make a couple of £100 by doing this, and it's probably going to take an hour of your time. And when you look at it like that, it's probably worth it. Yes, there's a little bit of a, do I have to, why would I do this now? But it's all about that 10-year picture of building your wealth up, and therefore I think really worth doing. Now back to some of the questions. Next question, someone's clearly been listening to my podcast, but they say, is taking money off a credit card to invest not really expensive? And yes, it is if you do it in the wrong way. So if you put your credit card into a cash machine and take cash out, they do have quite high charges for doing that. But what I'm suggesting is the balance transfers and money transfers, and shopping around for a credit card where there is a 0% fee and 0% interest for a certain amount of time. And normally you have to do that transfer within a certain period of having opened that account. So within 6 months of having opened the account, or 3 months of having opened the account. And then they'll give you that promotional rate of 0% for a certain period of time. So that's what I'm suggesting when I say borrow money off a credit card to invest. Also, it doesn't necessarily have to be invested in stocks and shares. At the moment, you can borrow that at 0% and put it into a savings account. And some of the savings rates at the moment are above 5%. So you can borrow at 0%, maybe with a 3% fee for the 16 months or something, put it in a savings account getting 5%, and then you kind of take that difference. You're making money off someone else's money, imagining it out of thin air. So when I say a 3% fee and then 0% interest, that 3% is an upfront fee. So if you're borrowing £100, they'll charge you £3 on the day. So when you are borrowing that money to invest, you have to remember that you will be paying that minimum amount each month. And therefore you don't want to necessarily, if you're very cash tight, invest the whole lot, because you'll need some back to pay off that minimum. If you've got your salary coming in as well and you can do it out of that, then fine. But if you're really tight, you might want, you look up exactly how much it is, the minimum you're going to have to pay each month, and put that to one side so that you can afford to pay that and not get stung because the money you've invested is locked up elsewhere. Okay, the next question seems to just keep coming, and it's where to look when you're starting to invest, where you're starting out. So for answering this, I'm going to assume that you have £100 to invest. If we're getting to the £1,000 plus, then we're starting to look at the venture capital trusts, etc. But real beginners, £100 to invest. And I'm going to assume that you don't want to lock it up because you might want that for emergencies down the line. So £100, I would be looking at putting it into shares. I would be looking at platforms like Free Trade, which I know I've mentioned before, but there's lots of other ones out there. And I'd be trying to put that into a stocks and shares ISA as well. So when you get dividends and when you get capital gain on that £100, you're not paying any tax on it. But also remember that there are kind of tax-free allowances at the very beginning of investment journeys anyway. So small amounts of capital gains are tax-free when you come to a tax return. Small amounts of dividends are tax-free when you come to a tax return. So you wouldn't necessarily have to start doing a tax return just because you've invested £100, and you wouldn't necessarily have to worry about putting it in a tax wrapper. But by putting it in that tax wrapper, when you do have more money to invest in the future, you've started to build up, because with an ISA you can put in at the moment £20,000 a year. So over 5 years, you can put in £100,000. So if you put it in an ISA now, when you do have money in the future to invest, you'll have used some of your ISA allowance from now, as it were, and you won't be putting strain on your allowance in the future, because at some point in the future, you might have more than £20,000 a year to invest, and then some would have to go into a non-ISA wrapper set of shares, and you'd be paying tax on that. So to start building it up now is a sensible idea. Also, because it's in that wrapper, it will be more of a driver to keep it invested rather than to pull it out. But with an ISA, you can withdraw the money and put it back in within the same year. So if you realise you actually you need that £100 to cover yourself to the end of the month, but then you want to put it invest again once you get paid, you can do that. So you can pull it out and put it back in within the same tax year in your ISA. That's all we have time for today. Thank you so much for listening. If you have any questions that you'd like answered, send them in to us on Instagram @RiskRequired or wherever you listen to your podcasts. And I'll be back with a new episode in 2 weeks' time.